I want you to picture two neighbors, both 63 years old, both retiring in 2 years. Both spent their entire careers doing the right thing, contributing faithfully to their 401k, watching the balance climb, telling themselves they were building something real. The first neighbor, let's call her Sandra. She is a high school principal in a mid-sized city. For 32 years, she maxed out her 403b retirement account every single year. Her balance today is $1.1 million. On her kitchen table right now is a retirement plan she and her husband built with a financial advisor 6 years ago. It says she can withdraw $55,000 a year in retirement and live comfortably on about $80,000 annually. Sandra feels secure. The second neighbor, David, a senior engineer at a manufacturing company, a balance sitting at $890,000. David figures he will draw $45,000 a year, collect Social Security, and land around $70,000 in annual retirement income. He has done the math. He feels ready. Here is what neither Sandra nor David has fully accounted for. Sandra's $1.1 million is not hers. Not entirely. Every dollar she contributed to that 403b went in pre-tax, meaning the IRS has never collected on it. The retirement plan on her kitchen table, built 6 years ago, does not fully account for a set of tax mechanics that most middle-class retirees discover only after it is too late to do much about them. David, at age 73, will be legally required to start withdrawing money from his retirement account, whether he wants to or not. And those forced withdrawals could push his taxable income into a bracket that costs him thousands of dollars per year in taxes he never planned for. This is a trap almost perfectly calibrated to catch the people who did everything right, who saved diligently, who grew large 401k balances, who by every external measure succeeded at the retirement savings game. It catches them because the trap is invisible until you are already in it. Today, we are going to talk about the hidden tax mechanics that are quietly destroying middle-class retirement accounts and the specific strategies that exist to reduce the damage, many of which are only available during the working years before retirement begins. Let me start with a concept that will change how you think about retirement savings for the rest of your financial life. Every dollar in a traditional 401k or traditional IRA is not your money. Not fully. It is a partnership. When you contributed those dollars pre-tax, you and the federal government entered into an implicit agreement. The account balance you see on your screen is not your retirement nest egg. It is your retirement nest egg plus the government's cut, stored together in the same jar, waiting for distribution day. The problem is that most people treat the pre-tax balance as if it were fully their own, build their retirement spending plans around it, and then discover in their late 60s that the government share is larger and more disruptive than they ever anticipated. Researchers consistently find that taxes are the single most underestimated expense in retirement planning. People plan meticulously for healthcare costs, for inflation. Almost nobody plans adequately for the tax complexity that emerges when Social Security, retirement withdrawals, Medicare, and RMDs all collide. The technical term for what happens at that collision is the tax torpedo, and it is real, it is widespread, and it is hitting middle-class retirees right now. The first thing you need to understand is how Social Security taxation actually works, because it works in a way that almost nobody explains clearly, and the mechanics are genuinely surprising. Most people think Social Security is either taxed or it isn't. Here is how it actually works. The IRS uses a concept called combined income, also called provisional income, to determine how much of your Social Security benefit is taxable. Combined income is calculated as your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits. If your combined income is below $25,000 as a single filer or $32,000 as a married couple, none of your Social Security is taxed. Between $25,000 and $34,000 single, or $32,000 to $44,000 married, up to 50% is taxable. Above those thresholds, up to 85% is taxable. Those income thresholds were set in 1983 and have never been adjusted for inflation. Not once. Today, the vast majority of middle-class retirees exceed the 85% threshold. And here is where it intersects with the 401k to create the tax torpedo. When you withdraw from a traditional 401k or IRA, that withdrawal counts as ordinary income. It raises your combined income. And every dollar that crosses the threshold triggers taxation of more of your Social Security benefit. A retiree in the 22% bracket withdrawing $1,000 from their IRA might effectively pay taxes at 33% or higher for that dollar, because the withdrawal simultaneously triggers taxation on another $850 of their Social Security income. A married couple with $38,000 in combined Social Security plus $40,000 IRA withdrawal, combined income $59,000. That triggers 85% of Social Security into taxability, roughly $32,300 more taxable income. Their tax bill? $8,300 to $9,500. They planned for $6,000. The problem gets worse as the account grows. A couple whose retirement account compounded from $400,000 at 60 to $700,000 at 70 by delaying withdrawals has built a larger trap for themselves. The reward for excellent compounding behavior is, paradoxically, a larger forced tax problem later. The second thing you need to understand is required minimum distributions, what they are, why they exist, and why they create a specific problem for people who saved successfully. The IRS requires that you begin taking minimum distributions from traditional 401ks and IRAs starting at age 73. The amount is calculated by dividing your account balance by a life expectancy factor. For a typical 73-year-old, that factor is roughly 26.5, meaning the required distribution is about 3.8% of the balance. On Sandra's $1.1 million account, the required minimum distribution at age 73 is approximately $41,500. Whether she needs that money or not, whether it pushes her into a higher bracket or not, she has no choice. The withdrawal is mandatory. A person with a balance of $1.5 million to $2 million at age 73 faces required minimum distributions of $56,000 to $75,000 per year, mandatory, non-negotiable, fully taxable as ordinary income. This can push a solidly middle-class household into a tax bracket they never anticipated. The people who built the largest 401k balances, who did the most right, often face the largest required minimum distribution burdens. It is a system that penalizes successful saving through mandatory income recognition at the least convenient time. The compounding RMD problem, a large account growing faster than you withdraw, will produce larger and larger RMDs over time, not smaller ones. The RMD in someone's early 80s can dwarf what it was at 73, pushing income steadily higher precisely when it is least manageable. When one spouse dies, the surviving spouse becomes a single filer. The Social Security taxation thresholds for single filers are dramatically lower. A surviving widow or widower can find themselves paying significantly more in taxes on less income. This is sometimes called the widow's penalty. I am not done yet. There is a third component of this trap that almost nobody discusses outside of specialized tax planning conversations, and it affects everyone on Medicare. Medicare Part B and Part D premiums are not flat. They are income adjusted. The premium adjustments are called IRMAA, the income-related monthly adjustment amount, and they are calculated based on your modified adjusted gross income from 2 years prior. The standard Medicare Part B premium is roughly $185 per month per person. At the highest income tier, a married couple can pay over $600 per month per person, more than 3 times the standard, just for Part B alone. A couple with $40,000 in Social Security and required minimum distributions from a $1.5 million traditional account could trigger IRMAA surcharges, not because they are wealthy in the traditional sense, but because forced taxable income looks like high income on paper. For a married couple in the first IRMAA tier, the additional cost is roughly $840 per year. In the second tier, roughly $2,100 per year. Across a 30-year retirement, those surcharges compound into a significant and entirely avoidable expense. The fourth thing you need to understand is the Roth conversion strategy, the single most powerful tool for reducing the tax torpedo, with a specific and narrow window of opportunity that most people miss. A Roth conversion is the process of taking money from a traditional pre-tax retirement account and converting it to a Roth account. You pay income tax on the converted amount now. In exchange, the money grows tax-free. Withdrawals are completely tax-free, and it does not count towards Social Security taxation, IRMAA calculations, or required minimum distributions. The window for strategic Roth conversions is the period between retirement and age 73, the years after you stop working, when taxable income drops sharply, but before Social Security and required minimum distributions begin filling your income back up. A 62-year-old retiring with $800,000 in a traditional IRA could have near zero taxable income for several years. During those years, converting $40,000 to $50,000 per year at a 12% or 22% tax rate is significantly cheaper than waiting for those balances to be forced out as RMDs at a higher rate. A couple who retires at 62 with $900,000, delays Social Security, and does no Roth conversions arrives at 73 with $1.2 million. And RMDs of $45,000 per year, stacked on top of $45,000 to $55,000 in Social Security. Over 25 years, the total lifetime tax cost could exceed $200,000. The same couple executing annual Roth conversions of $40,000 to $50,000 per year during those 8 pre-Social Security years will have converted $320,000 to $400,000 to Roth. Their IRA balance at 73 will be $700,000 to $800,000, producing RMDs of $26,000 to $30,000, meaningfully smaller. The conversions cost taxes in the short term. The lifetime savings are substantial. Tax researchers consistently find that systematic Roth conversions during the pre-RMD window represent the highest return tax optimization strategy available to middle-class savers. The backdoor Roth IRA. If your income exceeds Roth IRA contribution limits, $161,000 single or $240,000 married in 2025, you can make a non-deductible contribution to a traditional IRA and immediately convert it to a Roth. Same result, different tour. The fifth thing you need to understand is why workplace 401k design matters, and the specific contribution decisions you can make right now that will meaningfully change your tax picture at retirement. Many employers now offer a Roth 401k alongside the traditional pre-tax 401k. You contribute after-tax dollars, receive no immediate deduction, but accumulate retirement savings that grow and withdraw completely tax-free. Same contribution limits, $23,500 in 2025, $31,000 for age 50 and older. A household that has exclusively contributed to traditional pre-tax accounts for 20 years has created a retirement income picture entirely dependent on tax rates in retirement. A household with a mix, some traditional, some Roth, has tax flexibility that creates options. Tax flexibility is worth real money. The Health Savings Account, the HSA, is the only truly triple tax-advantaged vehicle in the U.S. tax code. Contributions are pre-tax, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. In 2025, individuals can contribute $4,300 to an HSA. Families can contribute $8,550. For households in peak earning years with access to a high-deductible health plan, maximizing HSA contributions is one of the most tax-efficient moves available. Now let's talk about what you do with all of this, because the strategies are specific and the timing matters enormously. This week, look at your current retirement account balances and identify what percentage is in traditional pre-tax accounts versus Roth accounts. For most people who have been contributing for years, the answer is close to 100% pre-tax. That percentage represents your future tax exposure, the share of your retirement savings on which the government still has a claim. Knowing that number is the starting point for every other decision. This month, find out whether your employer offers a Roth 401k option. If they do, consider splitting contributions, putting some into the Roth 401k. For someone in the 22% bracket who expects to be in 22% or higher in retirement, the Roth 401k may already be the better option for new contributions. This quarter, if you are within 10 years of retirement, have a conversation with a tax advisor or CPA who specializes in retirement income. Ask specifically about the Roth conversion window and your projected required minimum distributions at 73. This video is for educational purposes, not financial advice. Tax laws change. Individual circumstances vary significantly. Please work with a qualified tax professional or financial planner who specializes in retirement income before making any decisions. Now, back to Sandra and David. Sandra's $1.1 million is the product of 32 years of disciplined saving. But without a Roth conversion strategy in the next 2 years before retirement, she is walking toward a retirement where the tax torpedo is waiting. Her $55,000 annual withdrawal, combined with her husband's pension and their Social Security income, is almost certain to push up to 85% of their Social Security into taxability and to trigger IRMAA surcharges. The retirement plan on her kitchen table was built without this analysis. She needs it updated before she retires. David has a potentially more useful window. He's 58, still working, and his company recently added a Roth 401k option he has never used. He has 2 years to redirect some contributions to the Roth 401k before he retires. More importantly, he will have a 5 to 7 year window between retirement at 63 and required minimum distributions at 73. A period of unusually low taxable income, perfect for annual Roth conversions. That window, used systematically with annual Roth conversions in the 12% and lower 22% brackets, could meaningfully reduce the forced income from RMDs later, and with it, reduce both the Social Security Tax Torpedo and the IRMAA surcharges. Neither of them is in a catastrophic situation. Both are still in a position to do something about it. That is the critical difference between people who understand this trap in their late 50s and people who discover it in their early 70s. The tax trap does not primarily affect people who failed at saving. It affects people who succeeded. The person who never built a substantial 401k balance has no RMD problem, no Social Security torpedo, no IRMAA surcharge, because they have nothing generating forced income. The middle-class household that maximized the 401k, got the match, let it grow, didn't touch it, built precisely the conditions that make this trap most dangerous. It is the consequence of a tax system built for a different era, catching the people who did everything right. Telling someone to maximize their traditional 401k for 30 years without teaching them about the tax consequences of those balances at 73 is not complete advice. It is half the picture. The other half belongs here. The trap is not sealed. Not for most people reading this. Not for people who are still working. Not for people in their 50s. Not even for people in their early 60s who have a few years before the machinery starts running. The window exists. The choice is between discovering this trap now, while you can still navigate around most of it, or discovering it at 73, when the required minimum distributions begin and the options are mostly behind you. You have already made the first move. You know the trap exists. That is the only thing Sandra and David were missing. Everything else is a plan.